Welcome back. We begin in China, where the economy is showing some signs for concern after key data was released for the month of November, with the Statistics Bureau promising more measures to help boost domestic demand after the release of the figures. Retail sales missed estimates, rising just 3% last month from a year ago. But the figure also a sharp slowdown from the 4.8% growth recorded in October, prompting the government to promise more policies to boost domestic demand. November industrial production rose by 5.4% from a year earlier, and that's in line with Bloomberg projections. In terms of other numbers released, we saw fixed asset investment increase 3.3% in January to November from the same period a year earlier, as compared with an expected 3.4% rise. Property investment in China fell 10.4% for the first 11 months of the year, as new home prices fell at the slowest pace in 17 months. The world's second largest economy has been contending with pressure from multiple fronts this year, and just last week its top decision-making body promised to roll out more aggressive support next year as Beijing builds up its defenses against a potential trade war with the US. Chinese markets in a muted mood after the data release, reflecting concern over sluggish domestic demand. Let's check in on the Greater China markets. The Hang Seng Index in Hong Kong, just before the lunch break, is down 0.5%. Shanghai Composite is slightly above water, up by 0.1%, 3,395 points. And the second bourse is down by nearly 1%. Chinese currency also weakening against the dollar. Also on the prospects that the central bank is cutting the reserve requirement ratio for banks, and that's as a PBOC official said it had room to do so. The remarks also affecting trade in government bonds. Now, China's long-term bond yields hitting record lows in early trade here in Asia as easing expectations intensified. The 30-year Treasury yield reached a low of just below 2%. It is currently still at that level, while the 10-year bond yield fell to 1.75%, and that's where it's at now. Now, for more insights on the slew of economic data just out, Hao Hong, who is Chief Economist at GROW Investment Group, joins us now. Hao Hong, good to have you with us on the show. Tell us, what worries you most about the latest data released by the Statistics Bureau today?
Yeah, thanks for having me. I think the most glaring weakness in today's number is the consumption number, right, which is substantially below expectation. Given that the property market seems to have a little bit of pickup in October and November, and also the stock market had a really strong rebound in early October. It is a little surprised to see much of those gains is not transmitted to consumption, right? So consumption is down. Is well below expectation, and also because of that, one shouldn't be surprised to see CPI number, inflation number would be low as well. So I think this inflation or even deflationary pressure is starting to build up in the consumer sector.
Okay, so and that's the reason why more measures are being promised to help boost domestic demand, a key driver of growth for the economy, of course. So what sort of stimulus measures are you then expecting?
Well, I think between now and the twin sessions in next March, there will be a policy vacuum period right now. So, because the goals are, the specific goals will be set during the twin session. So right now it's just the objective, the plan to get there in 2025. I think between now and then, between now and next March, we will likely to see 50 bips triple R cut, and also some interest rate cut as well. Probably the mortgage rate, the home mortgage rate, probably would be lower after the rate cut and all that. So these are all conventional monetary policy moves. As we have seen so far, with multiple triple R cuts and also interest rate cuts, the Chinese economy failed to respond, and also the deflationary pressure is building up in the economy. So I think more unconventional moves will be needed. For example, how you strengthen the social welfare system, increase the healthcare reimbursement for Chinese households, increase the minimum tax bracket, for the Chinese workers, raise minimum wage, childcare support, educational expense relief, that kind of stuff. Many of these I talked just now hasn't been done before, right? So this would be rather unconventional, and it's directly, helping the Chinese households to get back on their footings.
So all eyes will be on the two sessions next year. But the data, of course, today's data comes on the back of the Central Economic Work Conference, which disappointed for the lack of details for fiscal stimulus. But the language issued from that key economic meeting, that has changed. Tell us more.
Yes, I think the language is the strongest in years. I think, they're talking about, unconventional policy moves, moderately loosening monetary policy, and also, promoting domestic consumption and expand the domestic demand. Many of these are new terms. Some of them, hasn't been used for more than 10 years. Last time, for example, when we used the terms moderately loose monetary policy, that was in 2008 during the financial crisis. Right? So it's showing you that, it's gaining a lot of attention off the top, and the top is trying to, make some move to support the economy. But then, because the work conference is really, to summarize, what we've done in the past 12 months, and also, laying out a plan for the next year. It's bound to have little details, for the market, right? So I think the market was too eager to hear, a rollout of specific plans to stimulate the economy. I think we just have to be a little bit more patient and wait until next March to see all the details.
And of course, there are some silver linings. I mean, some corners of the property market are already showing signs of life. Top-tier cities like Beijing and Shanghai. I mean, home buyers snapped up all the new units in a high-end Shanghai project this week alone. So do you think that the worst is finally over for the China property market?
No, I think it's too soon to draw that kind of conclusion. I think we had 2 months of consecutive increase, which is good. We're very, very pleased to see that. But remember, back in early 2023, right? So when the Chinese economy reopened from the COVID lockdown, there was 4 months consecutive increase, right? And then the market plunged again from there. So it's showing you that, because the Chinese household is very reluctant to take on new leverage to buy homes, and also home price, even though it has come down, 25%. It is still rather elevated, right? So now we're back down to the price level last seen in 2017, 2018. Right? So international comparison told us that price need to adjust substantially more than 25%, for the housing market to bottom out. Right? So one shouldn't be surprised to see 50% or more price correction in many of the housing markets over the next couple of years. I think Beijing and Shanghai and Shenzhen, these are the tier 1 cities. I think people in these cities tend to be well off and have very substantial savings, and that is helping them, to sort of cushion the downward pressure from the economy in the last couple of years. So the second-hand property price, for example, in Shanghai, has come down, sometimes by 35-40%, right? So it's a rather substantial adjustment. But given all the inventory overhang, right? So we have 3 years worth of inventory outstanding in the market, and plus all the second-hand housing that could become on stream should price start to recover. So I think it's way too early to draw a conclusion that the housing market is bottoming out.
Well, some green shoots, perhaps. Good to have your analysis. As always, Hao Hong, he is Chief Economist at GROW Investment Group.